Hopefully everybody's day is off to a good start. I'm excited about this one. I think this is going to be, very informative for people that maybe I don't know that you're going to be able to use everything in here today. You might be able to, depending on where you're at, but especially as price appreciation happens for digital assets and, people are looking to creatively mitigate taxes, structure things to protect it over the long term. I think Carson's going to be able to provide you guys with a lot of value in that aspect. We had, close to 1,200, maybe 1,300 people register for this. I know it is in the middle of the day, so I don't know that everybody will be able to get on here, but it'll be available and we'll email it to everybody afterward. Because I do think there's going to be stuff that you'll probably, hear and it won't, hopefully it will click, it'll land immediately. But some of this stuff is a bit more complex than just your standard, insurance policy. And many people, and myself included, there's just a ton in the industry for the way that these products are structured that make it, I don't want to say difficult to understand, but a little bit more complex than just, simple term life policy or whole life policy that you may have heard about in the past. But without further ado, I mean, we've got a couple hundred people in here, so I will go ahead and turn it over to Carson and let him get into the loan regime
Yeah.
component that we're going to run down today.
Yeah. Cool. And Jake, can you have your team give me the ability to share? We've got some slides to kind of help illustrate everything while we're working on that. Or if I need to, I can send them to Sydney real quick.
Good to go.
Um, cool. So just to introduce myself, my name is Carson Porter. I'm the COO of Exure Legacy, which is the insurance arm of Digital Ascension Group. Um, and I'm an advanced planning specialist. I've been in the business now for almost 12 years. Really have made my splash, I suppose, not to talk too highly of myself, but in the advanced markets area, which is why Jake and Carl hired me on to come be part of this project. I'm super excited. So what we're talking about today is what we call loan regimes. Let me get some slides up because this is a really neat concept that is underutilized and not talked about so much. So you always hear these buzzwords when it comes to life insurance, like Jake said, outside of just standard term life insurance or some of these other pieces, mortgage protection. But you don't hear about things like loan regimes. You hear infinite banking and so many other things, which can be really neat in the right place. But what we found for our clients with money or who have businesses or who are coming into money, which I think pretty much fits the mindset, the scope, and the mind frame of everybody here. You either already have some net worth, significant net worth, or you're expecting, hopefully with some price appreciation, to see that, right? So this is something we wanted to, more than anything, put on your radar. I want to make sure everybody knows this is not just another insurance presentation. Not going to go through and try and pitch you on some product. I just want to show you what's out there, what's available. And in the 20 or 30 minutes we have here, there's no way I'm going to be able to make you an expert at this. But again, if we can get it on your radar and equip you with the tools, the verbiage, the right questions to ask, the right conversations to have, then you can go about talking to the professionals you have in your life about these things. And if they don't know, then I know a few professionals on our end that are pretty dang good at this and would love to chat with you. So let's just cruise through. We want to set up, I guess, the conversation by talking about the problem. And that's that most affluent families or most people with money, they don't have money problems. They have liquidity problems. And liquidity, just because you have money, doesn't mean you can use that money. Liquidity and mobility are the two hardest pieces to get without getting hammered by taxes. That's why we use things like businesses. We hide our money in real estate, concentrated investments, and other illiquid assets. It gives us a really strong balance sheet, but weak cash positions. A cash position is how we can add utility to our wealth. How quickly and can we mobilize it and go do something? Okay.
I think this
And
is
then,
going to be most of the people in crypto, right? There's a joke
yeah.
out there that, you're crypto rich and cash poor.
Uh-huh.
And so, as that continues to be the case and we get the price appreciation, I think a lot of people may, and it's not that those assets are illiquid, they are, highly liquid, but you might, like to your point, you don't want to deal with the tax implications. So,
And yeah, that's exactly it. We love the appreciation, we love the asset, and the abilities we get with that asset. But it's right now in today's world, at least, it can be really hard to, go down to 7-Eleven and get a bag of donuts and a soda pop with that. So we've got to find a way to move from one area or transition from one place to another without creating these huge taxable events. Because these taxable events, just so most folks know, just depending, it can be anywhere from 20 to 50+% depending on how you take that money. And that really, frankly, sucks to think you put in all the effort, you put in all the work, you put in all the risk, you made all the right moves, and then you have to give up 20 to 50+% of it. And so that's what we want to avoid. Okay. When estate taxes are due, when income taxes are due, you got to pay them. When estate taxes are due, you have to pay them in cash. I don't know anybody that's found a way to get the IRS to accept XRP, for example, for their estate taxes yet. We'll see. We'll see what happens in the future, but who knows? But they're due in cash on a fixed timeline, and regardless of how your wealth is structured. Okay, so if liquidity is not planned, it becomes forced. Just so everybody understands this, that forcing, it looks like fire selling your businesses, discounted real estate dispositions. You've heard of like short sales, unfavorable exits, and then one thing we see in the planning world quite often is a lot of family conflict and loss of control of all that money. Do you see that on your end as well, Jake?
yeah, for sure. I mean, we've had people come to us with large amounts of crypto. There was one family I can think of in particular. There was a gentleman that had bought a bunch of Bitcoin in 2010. It was on a hard drive, and this one they were actually able to get to. There's been a few that passed on in the will, and they couldn't even get to the Bitcoin. But in this circumstance, there were five children. They were allotted certain amounts of Bitcoin each, and obviously it was much more than the estate taxes. The threshold here in the U.S. at the time. I believe a few years back it was like 20, 24, 25 million between the two spouses that they could pass on to the kids. And the kids received all this Bitcoin, which is great, great problems to have, champagne problems. But, they had to deal with the estate tax and the transfer of all that for anything beyond that 30 million. So insurance, I think, is a really unique and obviously well used way in order to pass that on without those implications.
Yeah. So, and we would never want to put everything in insurance, putting all your eggs in one basket. I've never heard anybody say that that's a smart thing to do. When we're doing planning, we like a little bit of um,
Diversification.
diversity. Yeah. And thank you for that. And and so same thing with insurance. We're not saying trade everything in for insurance. What we're saying is adding that to part of your plan creates the liquidity events that it creates the mobility you need in those moments, so that you don't have to have some of these consequences or create some of that conflict. Okay. So really we want to shift our thinking. Insurance it's a tool and structure is a strategy. Insurance is not just life insurance, is not just life insurance. Life insurance as a product is going to do some really neat things for us when you pass. And that's when we're thinking generationally, we're thinking more than the next 3 to 5 years. That's certainly a conversation we want to have. But at the same time, life insurance carries some very special tax structures that don't just let you accumulate inside the policy with some tax favorability, but they'll actually allow you through the use of life insurance to move money between your corporations, between your estate, between your trusts, much more favorably on the tax side, which is really, really neat. And that's what loan regime does. Okay. I want to spend some time going through the neat stuff, so I might just skip past this one here. But I do want to touch on this, and it's really part of the setup here. We have to stop asking ourselves if the reality or our reality, whether it's now or in the future, is that we come into large sums of money The question can no longer become how cheap do we do this? Because when we cheap out, we miss out. We lose so badly on the tax game and or the control game that it's just not worth it. So, um, not saying go spend again all your cash on life insurance, but I am certainly saying spend enough to have the result you want to have, and we'll get into where and how you spend that in just a second here. Um, but spend enough to have the result you want to have. Otherwise, you'll end up spending it anyways and substantially more on taxes, on attorneys, and other pieces that you probably don't want to spend your money on. So this is what we call stewardship thinking, moving from that investor mind frame of just how do I grow it to, okay, now I've got it, or I've done all the things I need to do to get it. What do I start doing now to take care of what I now have? Jake, do you have anything you want to add to that before I start getting
Yeah,
into
I
some of
mean,
the cool stuff?
a lot of people work in their W-2. They've invested a lot of money for them, whatever that means, into these opportunities. And if you're living paycheck to paycheck or you haven't had a long-term mindset, it's difficult to break out of that paradigm sometimes. But to your point, the families that have been successful at legacy planning and generational wealth transfer, they use this thinking. They're looking at wealth preservation. The families that I've consulted with, they're always looking for return of capital and then return on capital. They want to make sure that their wealth is continuing to grow with the inflation rate and their purchasing power is maintained through whatever assets or vehicles. And this is just a tool, right? Like this is just one of those tools that allows you to do that and also pass assets to your family without huge tax implications. Unfortunately, we're all going to pass at some point. It's not a fun topic, but there are some benefits that the government has put into place. Like we said, with the gift tax threshold, if you have 30 million in your personal estate on the day that you pass this year in 2026, all of that would pass to your children tax free with a step up in basis. So it's not like they would have, the same cost basis you did. They actually get a step up. So if they did decide to sell, there would be no tax implications for them on that first $30 million. But ideally, the wealthy don't sell assets, right? They continue to compound them, borrow against them, do things to mitigate taxes and structure it the right way. And I'm excited for Carson to get into this next part where he's going to kind of run you through how we can do that with insurance.
Yeah, let's get into it. So we want to talk about loan regimes. And what loan regimes are private financing structures. And they can look like different things. They can look like, and we'll get into some of these here, but many of you may have heard about things like premium finance life insurance. That is a loan regime strategy. There's loan regime split dollar, which is a really neat way to move money out of your businesses and trusts at like an effective 11-ish% tax rate versus 20, 30, 50%, depending on, is it capital gain or is it income tax? And do you have state implications on taxes as well? So to pay just 11 to move that same amount of money out, pretty stinking neat, if you ask me. But the loan regimes that we set up around these policies are what allow us to do that. Okay. What they effectively do is allow us to acquire large life insurance policies that are going to solve for estate tax issues if you're over that $30 million threshold. They're going to allow us to, again, move money between entities and in and out of our estate while significantly mitigating our taxable liability as we do that. And hopefully in the near future here, can't speak too much about it, but hopefully through these policies, we can also invest in some pretty neat digital assets as well directly through those policies. So super cool things coming down the pike with that. But we want to be able to do this without writing large personal checks because what does it, Jake, if you save 10 or 20 million dollars on taxes, or maybe you saved $1 million on taxes, but you had to spend 1 million on life insurance, either way, it's not in your pocket. Was it really worth all the hassle of doing it in your mind?
No, I mean, I think, below the tax hurdle, like you said. So if I spend 11%, but I would have spent 20 on taxes, like that's a fair trade. It's worth my time to do it. But if I'm going to spend more money or have more problems than just, the taxes, then probably not worth doing.
Right. Right. So that's exactly it. We want to be able to set up large solutions, large strategies without having to write those large checks all on our own. So we use things called loan regimes to pick up that tax arbitrage we're talking about and really to shift money inside the policy without us having to touch it, without us having to write these big checks, without us having to sell off our assets to write checks. Life insurance companies won't let you buy life insurance with digital assets at this time. So you would literally have to liquidate that to move money in, and we don't want to do that if we don't have to. So what is it and what is it not? Okay. Loan regimes are advanced planning architectures. They're not a product. The product behind it is going to be some version of life insurance. Okay. But they are an advanced planning architecture. Almost always, we're going to be coordinating with your CPA or tax professionals. We're going to be coordinating with attorneys and oftentimes even hiring what we call TPAs, third party administrators, because this is a lot. This is a lot. And for the average person who doesn't do this all day, every day, to be able to account for this at the end of the year, make sure they're not getting in trouble with the IRS or anyone else. They've got to be able to track that, document it, disclose that. And those TPAs, those third party administrators, for $1,000 a year will do all of that for you, which is really, really neat. Okay.
Right.
So this isn't a loophole. It's not a gimmick. This isn't, if this is, if you see somebody on TikTok, hey, come talk to me about premium finance, come talk to me about loan regime split dollar, come talk to me about, you can almost always bet that they are trying to gimmickize. That's not even a word, but we're going to create a word today. They're trying to make a gimmick out of it. Okay. This is not a mass market solution. These are very niche market solutions for those that have those problems. Okay. So an example solution I want to show you here: loan regime split dollar. This is really, really neat. Um, so loan regime split dollar allows a business or trust to loan you premiums for a personally owned permanent life insurance policy, and it gives you the ability to shift hundreds and thousands and even millions of dollars from your company structure to your estate while decreasing your taxable liability by 15 to 25% oftentimes on those distributions. We'll get into what this means in just a second, without decreasing your living liquidity or creating estate tax issues. So this is going to guarantee that your estate plan has massive liquidity, and with liquidity, we gain mobility, and has that massive liquidity event via life insurance when you pass, while simultaneously guaranteeing you get to put more of your wealth to work while while you're alive, personally, okay, while you're still living. And we do that through, again, massive tax arbitrage with this particular strategy. What we end up doing is, as you can see here, we take a company, a trust, a family office, and we loan premiums rather than sell off our assets, or move them out of the company. Now they're at risk. We loan them, and that loan does not create a taxable event. Now, for it to be a loan, we do have to account for that loan. That loan, we own it. Let's say I own my company and I own my life insurance policy. Well, I get to set up the loan terms. Those loan terms do have to be
Legitimate.
legitimate terms. Yeah,
Yeah.
we end up getting a document written by an attorney. That document is signed and notarized. Again, a TPA is going to help, or a third party administrator is going to help account for all this. But we're going to service that loan on what we call AFR, annual federal rate. And there's three different versions: short to long term. Usually we're looking at long term, but figure on about 4.5% is what we end up servicing. So that's our cost out of pocket is 4.5% instead of servicing the tax load we would have had. A good case in point on this, and then that policy, I guess let me touch on this, can be personally owned. If I'm under that $30 million value, it can be personally owned. If either my estate or my estate with that death benefit is going to exceed 30 million, we can set up a special trust just for that called an ILIT, irrevocable life insurance trust, to make sure that we're keeping that at arm's length from your estate and not kicking the can down the road with tax issues, right? But a great example of this, we actually have a client we're working with right now, and we're looking at moving at about $2.6 million per year for 10 years. So that's $26 million. Well, the taxable liability on that $26 million is probably to the tune of, for this individual, 8 to 10 million. Maybe with a little bit of extra planning, uh, might be able to get down to 6 to 8 million. Versus his total cost is going to be that 4.5%. And then at the end of the day, we do what's called a rollout. And that rollout creates another taxable event at about 6%. So we'll be sitting at about 10 and a half, let's call it 11 on that money. That puts his taxable liability at 2 million to almost 3 million, right? And that's a significant change, right? So he gets to keep $6-8 million more in doing this while creating that huge mobility and liquidity outside of his business. It was in his business. He loved that money in there, but his business can only do so much with it. Now that it's out of his business, the world's his oyster. He can turn around and put that into other businesses, deploy it into other assets, or do all sorts of other things. So really neat strategy and a great way for him to claw back millions of dollars of his own money just by setting this up. So pretty stinking neat what this particular loan regime can do. So why do these exist? Again, because writing those 5-10 million dollar checks, 2.6 million per year for 10 years, that's not smart planning. Okay. Wealthy families, wealthy individuals, those of us that are more forward minded than that, we keep money working, we keep assets producing, we keep capital efficient, and we keep our taxable consequences mitigated or minimized as much as we possibly can. That's smart planning. Okay. We don't move money without needs, and we find ways to engineer around the problem using legitimate tax codes, using legitimate laws, rules, and regulations that allow us to do this. Okay. Um, I'm throw this out there on social media all the time. You'll hear when people are talking about life insurance, what the wealthy don't want you to know. Well, first of all, I work with a lot of wealthy people, and they are salt of the earth. All the ones that I've met and have become my clients over the years, and they want everyone to know. They wish everyone would know, just nobody's willing to listen because it can be a little tough. It can be a little complicated. You are going to have to hire some professionals to help you along the way with this. But they really do want you to know that most wealthy people are the most giving people I've ever met in my life. So the wealthy do want you to know it, but the wealthy do use these strategies. That is not a lie. They do use life insurance. They just don't use it the same way that Ma and Pa are using it today. Okay,
I
so
remember when I started to sell insurance, I was Jake from State Farm for about 6 weeks,
with the
and
khakis.
yeah, with the khakis, and we I did auto and home and fire and life, and when I was looking at the life stuff, I saw whole life and term policies, and the more financial products, IULs and other stuff, universal or indexed, and I for like at the time I was had made a bunch of money, and I was like, this seems like a scam, like why would you do anything other than term? The cash value that builds in these policies, just like if you're making the minimum payments, just really isn't as beneficial, right? And at the time I was like, well, I could put this in stock market or other stuff and see outsized returns in comparison to what it's going to do here inside this policy. And over the last 3-4 years here, dealing with high level professionals like yourself, it's really become apparent that a lot of this is curated toward the affluent people here in the US, or in Canada, where financial products can be used inside of life insurance policies. Rockefellers own an insurance company, right? And a lot of the lobbying and laws around insurance were paid for by wealthy individuals. So, not to say that the average person can't benefit from life insurance. I think that, if you have dependents, you should probably be responsible and have something in place. But, all the cool stuff, you do have to have a little bit of money in order to participate and get the best out of it.
Yeah, you really do. And to your point, why is it built for the wealthy? Because, a lot of times the wealthy are the ones that are, if they're not writing the laws and making the laws, they're at least lobbying for it. I mean, Berkshire Hathaway has huge insurance positions. Almost every bank on the face of the planet, just so everybody knows, banks don't just buy life insurance, banks own the life insurance companies. owning the life insurance company is a tool that banks use to be more efficient with their own money.
Right.
Um, I mean, it's really an incredible asset that is misunderstood. And I think to your point, um, you kind of touched on this. It's the over commoditization of it, and to the point where it's annoying. If you remember Groundhog Day, the life insurance salesman in Groundhog Day that comes running out and is always bugging him, and like a lot of people, most folks, it's almost like this social training that life insurance is annoying. It's not sexy. I don't want to talk about it. It doesn't do cool things. It's just that annoying salesman in the street. And that's not the case. It unfortunately has become that in a lot of lights. And so we ignore it. But when we start to tune back in, we realize it's an incredible tool that helps money move forward in almost every way globally. And you mentioned Canada. Canada has some very, very favorable life insurance regulation and policies. So lots of neat things going on there. And we do have a Canadian partner at this point on life insurance. So that's really exciting. So again, just kind of wrapping up here, building wealth is one skill. Protecting it is a whole other skill. We've already kind of hit on that, but that's really what that steward mind frame is about. It's moving from just how do I get the money to how do I keep it? Because at the end of the day, it's not just about what you make. It's about what you get to keep. Okay. So if you have significant net worth, if you're soon coming into significant net worth, if you own businesses or real estate, if you care about multi-generational impact, if you want to avoid forced sales, if you think in decades and not years, these are strategies that might work for you. And when we say significant net worth, some of these strategies really don't make sense if you have a net worth under 20, 30 million. Some of these loan regime strategies are incredible tools if your net worth is 1 to 5 million. There's different ways to go about putting together a loan regime to most efficiently move your needle forward, even though it might not be the most efficient thing for the person next to you. So don't feel like there's just one option, one way through this. They're really incredible conversations to have when you're talking to the right folks. Okay. So throw this out there for everybody. Again, Exure Legacy is the life insurance arm and advanced planning life insurance arm of Digital Ascension Group. We've got phenomenal advisors. Most of our advisors have been in the business 20 plus years. They've done an incredible job helping everyone from our really ultra high net worth clients all the way to ma and pa who are trying to get to that significant net worth area. So whether you want to learn more about this, meet with one of our advisors, or if you're already in that position, you're already doing some things and you just want a second set of eyes on it, feel free to reach out. It's not going to cost you $1 to meet with one of our advisors, get a free consultation, and see what we can do for you, whether that's something new or just helping you better understand what you already have. So Jake, that's what I have. Do you have anything else you want to go through on this?
No, it was great. I think it's really helpful for people. I've just got a couple things that came to mind there at the end. So I was listening to a podcast. I went and had lunch the other day with a wealthy individual here in Dallas he's done pretty well. He's actually going through an exit on one of his businesses. We talked a little bit about insurance, but he also sent me a podcast about Patek. So I don't know if you guys know about Patek Philippe. Most people know Rolex when you look at high-end watches, but Patek's been around for over 100 years. And they're just crossed, selling or creating 1 million watches in the last 3-4 years here. Rolex does 1 million watches a year, so they've only curated stuff for like kings and queens and like monarchs, big stuff back in the day.
Yeah.
But one of their slogans is, "You never own a Patek; you only steward it for the next generation."
Mm.
And so that really got me thinking, we all buy these digital assets or whatever investment it is, your business. But at the end of the day, you own it for a period of time. It's, and you're preserving this for the next generation. And so you want to make sure that it's passed to them in the most pristine way, holistic way possible. Life insurance is a great vehicle to do that. But I made a post on Twitter that was called Digital Stewardship. Right. So I think again, that paradigm shift or that mind frame shift that Carson was talking about, a lot of people think like this is my money, and I would hope that as it grows, we do see significant returns on XRP and some of the other digital assets. That you start to transition, and you do own it; it is yours. You made the investments, but hopefully, you kind of pivot to a stewardship mindset where your family is also involved. And then separate to that, I just want to say, some people may read or watch this and think, okay, this is out of my range. I'll do it later. A lot of people that work with us want to be proactive about things. And one of the ways that you can do that is go ahead and set up a term policy that's convertible. So, if you don't have life insurance in place, you have dependents, you have a spouse, you have people that you care for, even if you're young, unfortunately, you never know what the future holds, right? I was talking to a client, went hunting with him the other day, and his brother had died at 43 years old. Healthy, good looking, 8% body fat, worked out all the time, gone, right? So, and again, not fun things to talk about, but as a responsible man and or an adult, it's probably good to have something in place. And if you underwrite things while you're healthy, people don't think about stuff till it's a problem. If you can be proactive and underwrite a policy while you're healthy, you can carry that health panel forward so that you're not going to have issues later if, God forbid, you have cancer or some other terminal illness that you're not going to be able to get coverage for. And then you got to come up with a different creative solution in order to be able to use these type of tools. So again, Carson put his stuff up there. If you feel inclined, hopefully this was just educational for you. And if you do, want to get us consult, I'm sure they would love to meet with you and explain things. That's what I love about Carson and the team. They're here to educate people and make sure that they're informed. They understand, what's going on. And again, we encourage you to go talk to other professionals as well, just like you mentioned at the beginning. You should be well informed at this point, or a little bit better than you were, and you'll be able to have that conversation with them. And it's not just us that does this. There are large people out there, but I think we're the only people that do it that are curating things toward those that have significant wealth in crypto. So
Yeah, I can say that confidently as well. And on the convertible good term insurance is going to be convertible. It's going to lock in that, and it's also you get to carry that health forward. But we're working with an individual right now that came out of Digital Ascension Group, and that individual's exiting his business, but he didn't have some of these structures set up before. And this year, future years, he's getting a rollout on some of his buyout. We'll be able to help him in the future years, but this year he's just going to have to eat it in the shorts on taxes because he wasn't a little more proactive. And to your point, proactivity can be as inexpensive as a term policy that costs a couple $1,000 a year, so that you're ready when it happens, because you don't know when it's going to happen, life or money.
100%. Well, thank you again for taking the time out this morning. I'm happy to open it up for a few questions here at the end. How much longer can you hang out, Carson?
As long as you need me for. I cleared my
Okay.
morning.
Well,
So
let's grab a couple here at the end before we wrap it up. And this is recorded. We've had a couple of people ask here in the chat. So those that did not make it for whatever reason, and those that did, this is recorded. It will be emailed back out to you, and obviously, we will probably share it in the mastermind and out there publicly at some point for people to have access. This person says may have been asked. Recording. Yep, we're doing that. If someone is 55 and healthy and has a term policy, what are the steps or fees to convert that? Moon time is soon.
all
There you
right.
go. That's a great
No,
question.
yeah, that's a great question. So first of all, we want to look at, is the policy convertible? Not all term policies are convertible. And so with a quick check, we can see, is it convertible? If it is convertible, it has to be converted with the same company that you've already issued that policy with. If that's, one company versus another, you're almost never going to be able to use one company's policy to convert to a different company. And so now we need to look at the permanent products, the cash value products that that company has, and see if they are going to provide an efficient solution for you moving forward. Once you determine that and you're set, okay, let's get this converted. The steps are pretty easy. You need to contact an agent that's appointed with that carrier. We're appointed with 80 some odd carriers, but we're not appointed with every carrier. There are captive carriers out there we can't work with. So you need to contact an agent that's set up with them, and that agent will run you through some paperwork. It's usually pretty simple, 3 to 5 pages. authorizing that move over, that conversion, a new authorization for a different payment, and that's it. With convertibility, it's guaranteed. You could have had rickets or scurvy or cancer yesterday, and they'll still convert it. Um, it takes 3 to 5 business days, typically speaking. And the only change or fees associated with that conversion is you start paying the premium base of the new policy, the permanent policy, which is more expensive than a term policy, but there's no additional fee for conversion. So,
That's great. We had Amanda raise her hand. I don't know if that was a mistake or not, but if you want to post over there, there's a chat box or the Q&A. Either one of those will be able to read what you got here. Couple more questions. Oh, we got a bunch more questions. Very good. This person says, you pay back the loan using taxable personal income?
on a loan regime split doll, I'm assuming that's what you're referencing, is the example I put up. No, you wouldn't pay that. What you would do is service annual federal rate through that funding period, say 10 years. At the end of that time period, that cash value policy, let's say it's a whole life policy, or it could be, Jake mentioned index universal life, or it's going to have an internal rate of return on that policy as well. These are not the same types of policies you would buy from Jake at State Farm. They're not retail policies. They do have pretty standardized and significant for life insurance internal rate of
Mitigation.
return.
Yeah.
Right. So at the end of that time period, rather than paying the loan off, what the company does is we call it a rollout. They bonus you that money. You do have imputed tax, but it's not imputed tax. It's not, oh, I got to pay 20% on that 20 million I just got. We go back to, we reference a term table, is what we called it. It's the 2001 term table. And we pay a tax per thousand basically on that. How we pay that, we don't want you to come out of pocket, is we take excess earnings out of that policy. Let's say, individual in the example I told you, 26 million. If at that point he's in his policy sitting on 32 million, we take that excess out, service that imputed tax, and now he owns that free and clear outside of his corporation moving forward. So that's how we would
During
do that.
during the installments that you have to pay on the loan, are you able to take that out of the appreciation on the policy, or do you want that to compound and you service those payments with personal income?
So either or both. Remember,
Okay.
you own the loan, and the loan
Yeah,
is
you
with
can.
yourself, so you can set those terms up. Oftentimes, we'll even set them up where number one, it's not compound interest, it's simple interest. And then
Okay.
secondly, where the loan may be accruing annually, but it's due in arrears. And so,
Okay.
yeah, so we'll pay that off in arrears. So we can do some neat things with that.
Very cool. So, yeah, you definitely want to work with an attorney and a professional to be able to structure the loan the right way, because it does have to be a legitimate loan. It can't be like, yeah, I loaned myself some money to do this or that. So let's say it's an illiquid asset that I want to be able to use to set up this policy. Is there a third party provider that provides that liquidity? How do I access that liquidity to fund the policy with cash?
Help me understand just a little better, so
So
I
like
so I
I've
make
got,
sure I
let's
yeah.
say I've got, $10 million in XRP.
Yep.
Okay. I don't want to sell the XRP, but I want to set up one of these policies. How do I pull the cash out of the XRP? Is there another lender? Who's in the middle to provide that cash to fund the policy?
Yeah.
Or is it premium finance?
So in that scenario, likely what we would look at is a premium finance. With premium finance, we're going to find a third party bank that's going to pay for your policy, and now you're just going to service an actual bank note as opposed to a loan with yourself. Um, we're always going to contend with loan to value ratios. Just because you have 10 million doesn't mean they're going to give you 10 million. But if your net worth is 10 million or you have a $10 million asset, I would argue we don't need 10 million of life insurance to cover that asset. We need the insurance to cover the taxable liability and the liquidity mobility liabilities associated with that. So we need 2 million, 5 million is all we need. So that loan to value isn't the end of the world. And yeah, we would work with you and work with banks to get those arrangements made. So
And and for a lot of these, I didn't understand a lot of this stuff until really, like I said, the last 3, 4 years. Um, some people will mech out a policy And it might be a good thing or a bad thing, right? So a MEC is a modified endowment in contract.
Hmm.
And in order to meet the laws and specifications here in the US and Canada, the amount of money that you put into the policy has to be spread out over a period of time. If you do a lump sum, that's when it becomes a modified endowment contract and you can't borrow against it. So it kind of defeats some of the purpose or liquidity that you're talking about. Still provides a tax benefit to your heirs, but if you want to access that during your lifetime, it becomes locked and cumbersome. So that bank will be loaning money each year to make that payment on the premium finance.
Yeah, we've done a couple neat structures with, and like you said, a modified endowment contract. It's not always bad. It does have some different taxable implications while you're living. It's taxed like an annuity while you're living, and then it's still taxed like life insurance when you pass. So it still passes tax free and probate protected, and all those neat pieces. But it can create some cumbersomeness there. There are some policies that have what we call a PFA or PDA account attached, where we can do a single premium, and it'll sit in a fixed account and earn 4 or 5% per year, guaranteed fixed interest for say 5 years, and it'll automatically drip 1/5 of that in over the course of 5 years. So it's not a modified endowment contract, while at the same time we're able to take that single payment. So again, it's like you said, it's not every shoe fits every person. It's what's the right strategy for you, Mr. and Mrs. Jones.
Yeah. Doug's
So
asked, he's older, he's got some XRP, no life or health insurance, he's got some sleep apnea, but he quit the typical medical system, but he's in good health. So, is there a way he could get with somebody that you want to throw the QR code back up on the screen,
yeah,
uh, and then he can book a time with you or one of the other professionals um, over there at Exure, and I'm sure they can run you through, all the different options that we have. We don't do health insurance today at Exure, but we do have that health share plan in the mastermind for people. So, I'm sure our team over there can explain some of that to you. It's a little bit different than health insurance, but it's a good solution for people that may be a bit older or, are paying, personal health insurance policy. It becomes pretty expensive, especially as you age.
yeah. And on the life insurance side, a lot of times we'll do what's called an asset-based purchase, which oftentimes does become a modified endowment contract. So we're not getting all of the tax favorability, but we're getting a good chunk of the tax favorability, and we're getting the financial vehicle to move us forward into future generations. When we do that, it's really neat. I actually helped a client with something similar just last month, and we took $100,000. This individual, by the way, was 74 years old, and not in perfect health. We took $100,000, put it in. It only buys him as a single payment. It was like 180,000 of life insurance day one, but he had like 90, I want to say it was close to 95% liquidity on that money in the policy day one as well. So it wasn't $100,000 out the window.
That's great.
Um, what he was able to do at that point, number one, he can leave it in the policy and pass it forward with with that tax favorability. But if he needs those funds now, he can take a loan from that policy. He's over 59 and a half, so he won't have a taxable consequence on anything under what we call cost basis. Um, so, I mean, if he took a loan today, he's not going to have a taxable consequence because he
Well,
doesn't have any
and
earnings
you
yet. It
don't have
has
to
a
pay that back either. Like that's the whole point of
correct.
infinite banking with the life insurance policy. If you borrow against that, the death benefit, the cash value will pay that off. Um,
Right,
so that
right.
kind of leads to the question here. Joseph's asked, he's got no kids, he's got no beneficiaries, he's in
That
his
I know
50s.
of.
Well, that you know of, yeah. If somebody is in that position, a lot of people use life insurance because they have dependents, they have loved ones. What's the most, advantageous way somebody that doesn't have those things could be able to leverage this tool?
Yeah, absolutely. So, if you, in fact, I have a client, she's got about $10 million in real estate, and she doesn't have any family. She doesn't want to leave it to siblings. She doesn't want to leave it to, here's the reality with no planning, you don't get control. The state's going to take control, and you're going to give assets, or you're going to give something to next of kin, and or the IRS, and or the
Uh,
attorneys who
that
litigate
rich
this
uncle that
stuff.
died, everybody dreams of that scenario.
Yeah.
So, but this
So
way you
so
get to
yeah.
appropriate it the way you want to. Is that kind of the?
That's it. You can this gal, she's got 100% of it going to a I think it's called Best Friend Society. Uh, they're a
Charitable
wild animal
foundation.
reserve in southern Utah.
Oh, cool.
Um, and she's like, that's the thing I most care about. I still want to, if I have anything left when I pass, I still want to be able to direct and control it. And so, yeah, we've used some very similar strategies to help make sure she can do that efficiently and they don't get killed in tax. So,
Well, and she could borrow against it. I mean, she could borrow the whole thing, and whatever's left would end up going to
yep.
um, that charity.
Yeah. Yeah. So for her, if I remember right, we put in a few $1 million. She ended up with about 10 million in life insurance, which effectively doubles the value of her estate. Um, but she can loan that couple $1 million back out to herself and use it while she's living. And then if she passed and the loan was still out, they'd still get, 8 million extra bucks or whatever the case may be. So there's lots of neat things she's able to do with that.
Well, one of the anonymous attendees here says, "How much is it to convert or set something up new if it's not a convertible policy that you have?
Um,
You have to start
Depends.
fresh, or is there something you can do with the other one?"
So yeah, if it's not a convertible policy, what we have to do is start fresh. The cost of the policy is going to be the exact same because when you convert, you're getting the new policy. They're just guaranteeing your, we call it insurability. So you got it when you were 20 years old and healthy. Now you're 35 and you put on some weight and all these things. You're still going to get the health treatment as if you were 20. They're still going to rate you as a 35-year-old at that time. So the cost of the policy is still going to be the same that it would be for a brand new policy on a healthy 35-year-old, for example. So if your term is not convertible, you're going to have to buy a new policy. It's going to cost the same. The only downside to it is simply that you have to prove insurability. You're going to have to forgive me for being crass, but probably pee in a cup. You're going to have to give a blood sample. They're going to take your blood pressure, and you have to be underwritten for the policy
Again, you
to
wouldn't be
get
able
it.
to use that
So,
previous health record that you got on that first one if it's not convertible.
right.
So that's kind of what you're hedging your bet on. So you could wait, but if you did want to make sure you're healthy now, getting this done now and paying a couple thousand a year in premium for the term policy
Yeah.
saves you that, and it could be much much more expensive if you do have a terminal illness or you aren't quite as healthy as you are today later on when you decide to do this. Um,
Piggybacking on that just a little bit
yeah,
too, just so folks know, let's say you're not the healthiest right now, and so you're like, oh, I'm going to wait till I lose that 50 pounds or whatever. Tomorrow's not promised. I would still put your plan in place today, but you can re-rate existing life insurance.
oh really?
I re-rated one of my own policies. I know I'm not. I don't look like a spring chicken now. I still have too many extra pounds, but I used to have almost 100 more extra pounds.
Oh wow.
And yeah, on my very own policy, I was able to re-rate it, and that decreased the cost of my policy significantly. That was like 4 years after I had initially bought it. Um,
Oh
so
wow.
there's
Okay.
some
So
interesting things you can do there too.
yeah, so if you might not be the healthiest right now, but you plan on getting in shape and kind of reducing some of those health markers, it's kind of like refinancing a house.
Yeah,
Like you could
yeah.
kind of average down if the rates come down type thing.
Yeah, and the nice thing about it, let's say, you lost the weight, but in the meantime, something else came up that you weren't even aware of, where normally they would say, oh, we won't even give you a policy. Legally, they have to allow you to at least keep the policy you had. So they can't make it any worse, but it can certainly get better. So if you believe your health has improved, chat with your agent on your existing policy. There's a good chance you can cut your cost on what you already have. You're going to have to do the underwriting part again. But if you can prove you're healthier, they are guaranteed to not make it worse. Could be a whole lot better.
This is another one here says, is it possible to use this strategy if you have no taxable income? I have money and assets, but my income doesn't count as taxable. I have been turned down for life insurance for this reason before. I'm 38 and healthy.
Yeah. So that's where we would look at different companies. Some companies, based on when we underwrite, especially anything over like a $5 million death benefit, they don't just look at your health, they'll look at your financial standings. In other words, they don't want to give a $10 million life insurance policy to some bum off the street. They want to make sure that you deserve it, frankly. And some of these companies will only look at um, income as a source of funds. Many other companies, though, will look at estate valuation. They'll look at business valuation. They'll look at your total balance sheet, and we can use that as the financial justification. So it takes working with the right company, and then it also takes talking to the right people at the company because the folks in, let's call it customer service, most of them, they're great people, but they're not the top tier advanced planners doing handling these one-off cases like your circumstances might be. They're doing more retail insurance, $500,000 term policy for to cover somebody's mortgage who has a W-2 job, and just kind of more retail shop stuff. So we got to talk to the right companies, have the right agents, and then talk to the right people at those companies.
There you go. So yeah, sounds like we could figure something out. I'm going to shotgun these last couple here before we wrap up the hour. This person asks, can this be used for family property valued over $1 million with no mortgage?
Yes, but I think there's better strategies out there for that scenario. Um, Depending on where you're currently at with that property and what your goal is. Um, we'll use life insurance lots of times. We don't always use a loan regime for it, but we can. We can. We've done loan regime in the past with real estate. And done well with it. So it's not as common. Usually we'll use some other type of strategy to solve for your goals most effectively, but we could do it. So
Cool. Other person's asked if we do term policies. Yes, we obviously do the term policies. They asked if we can speak on the details. I would say, again, I sound like an attorney, but it depends, right? Like there's a lot of context and nuance in what that might look like and what's going to be best for you. And that's why Carson and the team there are in place. Book a time with them, chat. They're going to be able to give you, a couple options that are going to be the best for you in your circumstance. Anything you'd add there?
I would just add if you're going to go somewhere else and look at it, more power to you. Good term insurance is always going to have a few key pieces besides just affordability and a death benefit, right? Good term insurance is going to be convertible. Even if you don't think you're going to go buy a whole life policy or an IUL or something with it later, things change. And we see that change happen oftentimes around the same time you make money. Your mindset's going to change. So just have the option there. It doesn't cost any extra money to be convertible. And then number two, in my mind, is what they call accelerated benefits. Accelerated benefits are reasons why the company will pay out all or a portion of the death benefit while you're still living. Things like terminal illness, long-term care, cancer. If you get cancer, they'll pay out a portion of your policy. What we want to do and again, with a good term policy, you don't even have to spend extra on that. If it's $80 a month without them, it's $80 a month with them. That's good term insurance. But we want to create that buffer on your portfolio. That way, if, heaven forbid, you do get sick or something does happen, you have this major income interrupting life event, you don't have to turn around and liquidate some of the assets you're waiting on price appreciation for at a time that maybe isn't the best to liquidate them and maybe creates an unfavorable taxable consequence in doing that at the same time. So it costs you nothing to have those two pieces, convertibility and accelerated benefits when you're working with good term insurance. So yeah, if you're not going to chat with us, that's totally fine. Make sure you're bringing those two key pieces up with your advisors.
Love that. This person has asked if a VGLI is convertible.
I'm not.
Variable global life insurance. That's my
Yeah,
best guess.
I'm not sure. If it's a variable universal policy, it's not convertible because it's already a permanent policy. Um, Outside of that, I'm not sure what VGLI is. So if we can get some clarity on that, I'd be happy to provide a better answer. I apologize.
As far as this, how soon will interest rates to take loans out on XRP be lower? Guesstimate. We're working on those solutions today with partners. There's a prime broker that we're talking to about that, and we will announce that as soon as we have it. I promise you. Jonathan Fry says, when opening a policy, how do you fund it crypto or cash? And how can you put in is there a limit? How much can you put in? Is there a limit? And can you keep adding? Is there a monthly fee? Yeah, so
Um,
yeah, I'll let Carson run that one down.
oh, sorry. Uh, Cannot be funded with crypto right now.
Not
Would love to
today.
see that change in the future, but right now cannot, and that's why we use um, loan
Loan
regimes
regime.
and different structures to create liquidity without having to liquidate what you have. Um, and then actually, Jake, one of our Exure advisors is kind of watching in the chats and on the call. Just shot me a message that'd be Veterans Group Life Insurance. It's a company, and I do not believe, I'm pretty sure they are not convertible. But double check. Um,
VGLI. Okay. Um, yeah, so you would have to service the premiums. There's a monthly payment, that's for life insurance, but that's going to be any type of policy that you have
yeah,
for the most part, unless it's constructed the way that Carson was talking about, where it's paid in arrears, or have a loan facility with some counterparty.
yeah.
Morgan's Point Ward, they say I'm 62, 100% disabled vet with cancer. I'm not going anywhere soon. I want to take advantage of some of the insurance products after XRP price appreciation. What options do I have? So let's say that somebody does have a pre-existing condition and they're a bit older. I don't. He didn't say if he has kids or not, but what would be some of the ways you could structure this to do legacy planning if somebody is more difficult to insure, Carson?
Yeah, so life insurance is not all upside. There are downsides. One of those downsides is insurability. When we have somebody with pre-existing conditions, sometimes we can get past those in underwriting. With cancer, it depends on what kind of cancer was it, how long ago, are you in remission, have you stayed in remission, and we can work with a good agent's going to be able to work with their company and potentially still get you a policy with something like cancer, as long as it's not still active. There are some things that we just simply can't overcome. With those, there's different kinds of policies like guarantee issue and what we call simplified issue, but oftentimes those aren't the best policies for these types of strategies. And so if we can't get it, that's kind of the downside of it. And Jake, I think that's why you're saying, for those that don't have health issues yet, do something. Even if you're not going to do this, get that term policy in place and maybe you do something with it later, right?
Right.
Um, because there comes a day, and you mentioned it earlier, once it's already happened, what do you do about it? We used to say, I started in home auto life as well with a similar carrier. And we used to always tell folks, you can't come and buy homeowners insurance once the back porch is already on fire. You can't do the
Right.
same thing with life insurance. And so, unfortunately, that's kind of the answer. But that being said, that doesn't mean that with some quality advanced planning, some corporate layering and structuring, some trust layering and structuring, and maybe the use of some insurance products or other financial tools that you may not have been plugged into yet, because we've got Digital Wealth Partners that does a phenomenal job with that on the other side of things with the money management and planning. So I still think there's probably a way to move your needle forward. It may not be this way.
Yeah. Well, and maybe your kiddos could be underwritten. I've seen some people do,
Yep.
some policies on other family members, and you work out how you're going to fund those things. So again, you want to talk to the right professionals, and I'm sure you could figure something out. Unfortunately, I do have to cut it here. There's a question about PPLI that I would love to answer. We're going to do a full webinar on PPLI here in the near future. We have a really cool product coming to market for that. So stay tuned for that one. And again, if you do want to schedule a time with the team, QR code's there on the screen. Just scan that. It'll take you to the website, and if it's free, free consult, have a conversation, and figure out what's best for you and your family. Carson, you have any final thoughts before we wrap it?
No, that's it. Just again, meet with somebody. Y'all are working way too hard and you're investing way too much. You've come way too far to not meet with somebody. We'd love to meet with you. But if you've got somebody else, hopefully we've been able to arm you with the right conversations to have. And maybe you do something totally different, but it just sparks the conversations that you're not already having. So that's the goal here.
I love that. Well, thank you so much for taking the time and the education. I know there were people in the chat saying this was valuable. This is recorded. It'll be sent to you. And we got another webinar later today, so check that one out. But yeah, I appreciate the time, and we'll see you guys on the next one.